All right. Our next guest is Tom Welch in the California Earthquake Authority, Chief Counsel and Compliance Officer. Tom first joined the CEA executive team in February of 2019 as CEA's General Counsel, managing the delivery of all legal services, as well as CEA's enterprise compliance, internal audit, and government functions. Tom has a lengthy and very impressive credential. During his time at CEA, he has twice served as acting chief operating officer with responsibility over human resources, facilities, and CEA Enterprise Project Management Office. In the second half of 2019, Tom also led CEA's implementation the California Wildfire Fund, a $21 billion insurance fund that covers losses from wildfires ignited by California's three large investor-owned utility companies, PG&E, SoCal Edison, and San Diego Gas and Electric. In his current role as a chief counsel and compliance officer, Tom continues to manage all legal compliance, internal audit, and legislative function, and also manages CEA's technology teams and operates CEA's insurance policyholder system and IT function. Prior to joining CEA, Tom spent 30 years as a partner of a very prestigious law firm, Orrick, Herrington Sutcliffe LLP, where his insurance regulatory practice focused on providing compliance advice to numerous emerging and disruptive tech companies as they navigated complex insurance regulatory issues. For 28 years, Tom also served as an outside counsel to Insurance Commissioner's Conservation and Liquidation Office, which is the office that administers the conservation liquidation of troubled California insurance companies. So without further ado, I give you Tom Welch. Tom, the floor is yours.
Thank you so much, Bobby, and thank you for the kind invitation to come and participate in the SDAC meeting. This is my first one, but I guarantee you it won't be the last, because I'm already learning things from these presentations and from my colleagues who were involved in our DAC and who have stayed involved in SDAC. Let me go ahead and take 1 second to share my screen. And are you, let's see.
Take all the time you need, Tom. We have till noon.
I'll try not to take that much. Are you just seeing this Zoom?
Yes,
Okay,
we can watch your screen. It's shared in presentation mode.
There we go. That should be the right one. Too many screens. Are you seeing just a CEA slide?
Yes, correct. We're seeing a CEA slide that says Statewide Disability Advisory Council.
Perfect. Thank you. I may manage IT, but I'm not always as adept as I could be. So what I want to do is just give you, spend a little bit of time talking about CEA's roles and activities, not just on the earthquake side, but our mitigation program and our involvement in the administration of the Wildfire Fund, and tell you some of the origin stories to all of those, because they are interesting and frankly quite current. And then I'll spend the second part really just talking about some aspects of the management of our company and our workforce. We've got about 145 employees here at the CEA. We have a large pool of assets that we manage. We've got two different insurance funds, the Earthquake Insurance Fund and the Wildfire Insurance Fund. Collectively, they represent about $40 billion worth of claim paying capacity across those two perils, and about 18 to $20 billion in assets, hard assets under management. Actually, probably just a shade more than $20 billion as of today. And then I'll talk about, in the second half, I'll talk about how we operate our company and what some of the things we have been doing historically to focus on disability access, inclusiveness, and diversity. We think of disability access as really an integral part of our commitment to diversity and inclusion. So I'll start with the CEA origin story. We are not a state agency. We are entirely privately funded on the earthquake side of our business by the homeowners who buy insurance policies from us. Here in California, if you buy homeowners insurance, the peril of earthquake is excluded from homeowners coverage, but under California law, insurance companies that offer homeowners insurance are obligated to offer their customers, when they issue a homeowners policy and no less than every 2 years thereafter, the opportunity to buy earthquake insurance. Our origin story really arises out of the fact that the insurance companies in the 80s and 90s were issuing riders to their homeowners policies or independent earthquake coverage policies, because to those people who wanted to accept the offer for earthquake insurance. But they weren't paying a whole lot of attention to the important aspects of how to calibrate what their potential loss exposure was and how much premium to charge. And when you get to 1989, you had the October 1989 Loma Prieta earthquake in the Bay Area, which was damaging. It wasn't a huge event for residential properties in the Bay Area, but anyone who was around then remembers it. It affected Sacramento, and it deeply affected the Bay Area. A section of the Bay Bridge fell down. This was the earthquake that happened during the Bay Bridge World Series, where the San Francisco Giants were visiting Oakland and playing, I think, Game 5 of the World Series. The earthquake hit. They had to call off that game and postpone it. And then 4 years later, in January of 1994, you had the Northridge earthquake down in the Northridge area of Los Angeles. That was really a very significant residential event, because Northridge is a bedroom community of the greater Los Angeles area, and where the earthquake hit caused a huge amount of damage to residential properties there. And so over the course of less than 5 years, you had two very significant events that caused very significant economic losses to the insurance industry. And their response was to pull back away from offering homeowners insurance, because they were worried that their solvency would be imperiled by also having to take on the earthquake risk. That then precipitated a real estate crisis, because you can't buy or sell a home in California if you need a mortgage to do so, if you can't also get homeowners insurance. So you had what started as an insurance crisis that then spilled out and started impacting California's residential property market in a really significant way. The legislature jumped into action with the help of the insurance commissioner, the treasurer, the governor's office, and the insurance industry, and CEA was born. And CEA was created to be an insurance provider just for earthquake, just in California, and only for the customers of what are now a group of 24 homeowners insurers that agreed to capitalize us and continue to support our operations by doing policy administration, claims administration, and making some of their capital available to build our claim paying capacity if we have a really big earthquake that produces a significant amount of claims for us. The benefit to the state of California was getting that earthquake risk off of the balance sheets of the largest homeowners insurers in California, allowed them to come back into the market, start issuing homeowners policies again, and that resolved not only the insurance crisis, but the related real estate crisis. And we now are up to more than 1 million policyholders across the state. As I mentioned, we're entirely privately funded. We're not part of the state budget. We have actually around between 19 and $20 billion of total claim paying capacity. About 8.5 billion of that is invested assets, and the rest is reinsurance, which is insurance for insurance companies that spreads our risk here in California globally across financial markets. And we operate on an entirely not-for-profit basis, both in the state of California, which the legislature did statutorily, but also federally. We don't pay federal income tax, which allows us to build capital and preserve the premiums that our customers pay in as we await the next big damaging earthquake. The reason we can operate on a tax-exempt basis is because we're publicly managed. We're managed by a governing board of 3 important people in the state of California: the governor, the treasurer, and the insurance commissioner, all of whom can serve on our board through designees, and typically do serve through designees. That public management, coupled with our earthquake mitigation mandate, which I'll talk about in just a sec, was enough integration of CEA's operations into the overall state of California and the preservation of the welfare, the broader welfare of California, to allow the IRS to say that we can operate our insurance business exempt from federal income tax. We are an integral for the IRS's, from the IRS's standpoint, we're an integral part of the state of California. The mitigation mandate that I mentioned, included in our statute, is a mandate that we take 5% of our investment earnings from our portfolio up to a max of $5 million a year and put that into statewide earthquake mitigation programs. In 2013, we established our first really big program. We had accumulated about 25 million by that time. We just hadn't figured out how to deploy mitigation money and the loss mitigation funds that we had accumulated in a way until we hit 2013. And then we built out the Earthquake Brace and Bolt program. This is not just the California Earthquake Authority that is doing this. We're doing this through a joint powers authority that we established with Cal OES. And as many of you know, when there are large natural catastrophes anywhere in the United States, FEMA, the Federal Emergency Management Agency, not only covers, helps the communities recover, but under the Stafford Act, when a really big natural catastrophe happens, the federal government, FEMA, makes pre-disaster hazard mitigation funds available. And Cal OES is the agency here in California who takes California's share of those loss mitigation grant monies and distributes them to programs that can help people mitigate against natural catastrophe risks. So our partnership with Cal OES allowed us to create this JPA, which is called the California Residential Mitigation Program, and it stood up the Earthquake Brace and Bolt program. What we did was we focused on a particular type of house, the kinds of houses you see all through California, built in mostly the 20s, 30s, and 40s on perimeter foundations, and they're the classic bungalows. You walk up the stairs to a porch and into the house, and they sit on top of what's called a cripple wall that lifts above the foundation and gets you up to that porch level. Those are very vulnerable, and there's a lot of them here in California. What the Earthquake Brace and Bolt program does is it provides $3,000 grants to homeowners. They don't have to be our customers. Any homeowners who own a home like that and want to mitigate the home. We developed a plan set, and people can hire contractors through our website and go out and mitigate their home by putting together braces and bolts that will hold the house on top of that foundation in the event of an earthquake. We're up to about 23,000 homes that the program has retrofitted. We currently are trying to deploy an $80 million FEMA grant. So we're going to be able to do another 20,000 plus over the next couple of years as we take those funds and continue to distribute them. We've got a great track record of doing that kind of work effectively and being an effective, reliable implementer of mitigation programs. And so the program is now moving to additional types of homes, not just those older cripple wall homes, but also soft story, what are called soft story homes, the homes that have living space above a garage. That big opening in the garage makes homes unstable. And there are engineered retrofits that can help stabilize those kinds of homes. And then until this budget crisis arrived We had some seed money in the budget from last year that was earmarked for the CRMP program to help stand up a multifamily soft story program. Think of those classic Los Angeles area and Bay Area apartment buildings with a couple of floors above a drive-in garage or parking carport underneath. Those are also the kinds of homes that were damaged very severely in both Northridge and in the Loma Prieta earthquake in 1989. So we're starting on that. There's also some FEMA money that's coming in to help us start the multifamily soft story program. So we're proud of that. What you hear, FEMA's statistics point out that mitigation really does work. For every dollar overall, for every $1 that you put into pre-disaster mitigation, you're going to save anywhere from $3 to $4 to $5 to $6 on recovery costs. So mitigation really does work. One slide we like to show is from the 2014 Napa earthquake. These are two of those kind of cripple wall homes. You can see down at the bottom of this gray house or gray blue house on the right, the cripple wall, they sit on top of a foundation. This home had been retrofitted and it stood up during that 6.0 Napa earthquake in 2014. The house next door, which you can tell was built around the same time with the same construction, had not been retrofitted. It fell off of its foundation, and it took hundreds of thousands of dollars and a number of years to get that house restored. The woman who owned that yellow house on the left did not have earthquake insurance, so she had to borrow money and make it work. And she eventually got there, but mitigation really does work. It's an investment that is very important, and we're continuing to foster that and work hard to try to make mitigation programs and grant monies available throughout the state of California. The last piece of our functions is relatively new. In 2019, as Bobby mentioned, I spent 30 years at a global law firm. CEA was actually a client of mine from when it was originally founded. I was working for the Department of Insurance. They pulled me in to help draft some of the statute that now I'm charged with enforcing and operating CEA under. One of my colleagues, who was a partner at Orrick at the same time as me, is a woman named Ann Patterson. She is currently the governor's cabinet secretary. And she and I left Orrick at the same time. She went to work in the legal as the chief of staff to the legal affairs secretary. I came here as general counsel to CEA. And one of the first calls I got when I arrived here was from Ann, because her first task was to solve the PG&E bankruptcy, or work with a team of people, form a team to help solve the PG&E bankruptcy and help solve some of the financial instability that was swirling around the largest investor-owned utilities, because the rating agencies were threatening to downgrade all of the other utilities if the state of California didn't address the fact that the utility companies are strictly liable for any losses that occur if their infrastructure is involved in igniting a wildfire. And as you know, 2017, 2018 were just devastatingly cataclysmic wildfire seasons. So 2019, the state needed to act. And Ann, because I was here managing a catastrophe insurance fund, part of the solution to the peril that the utility companies were in, and consequently ratepayers were in, was this uncertainty. We had one bankrupt utility, and had the other two been downgraded, they would have probably had to go into bankruptcy as well, because they would have fallen into default because they were downgraded under all their debt, billions of dollars of debt. And they probably, I don't know for sure, but there was a serious concern that they might have had to have they might also have found themselves in bankruptcy or near bankruptcy. So that was the peril that the state, the Newsom administration and his team, and the legislature and the California PUC were working together to try to resolve. The result was a piece of legislation, AB 1054, that not only created a new insurance fund that helped helps insure against this natural catastrophe peril, but also did a number of other related things, forcing the utility companies to really double down on their investments in infrastructure safety, mandated that they spend at least $5 or $6 billion of stockholder money, not ratepayer money, but their stockholder money on hardening their systems to keep our state safe from utility-caused wildfires. And then the legislation also stood up a new Office of Energy Infrastructure Safety. It started in the CPUC and now is spun out and is on its own, and that's an important part of that as well. With respect to the fund, though, the way insurance works, the utility companies go out, they buy insurance, and then they pass the cost on to ratepayers. And what was happening was the insurance markets globally were unwilling to sell insurance to California utility companies. And so the creation of the Wildfire Fund was a solution for the fact that they were having a hard time finding insurance, and the insurance that they could find was getting really, really expensive. And so the fund was created. It's a $21 billion in claim paying capacity fund that insures just 3 utilities: San Diego Gas and Electric, Southern California Edison, and PG&E. And it's funded basically 50-50 between ratepayers of those utility companies and the stockholders of those utility companies. We've gotten about $10 billion, well, a little bit less than that. But by the end of a couple of years from now, we will have received $10.5 billion from the stockholders of the utility companies. And over a 15-year period, small surcharges are paid by the ratepayers and go into and create claim paying capacity for the Wildfire Fund. So I helped Anne understand how to stand up, or how CEA had stood up and capitalized this kind of a catastrophe insurance fund to cover the earthquake peril. And once the deal came together, I got a call from Anne, and she said, you know, come on over to the governor's office, come to the Horseshoe. We have a question we want to ask you. So the question was actually first a statement, which is this deal is coming together. It's going to happen. This fund's going to be created. It's an urgency legislation, and it will come into effect immediately. The state will capitalize it with a $2 billion loan, which we're ready to fund in a couple of weeks. And the question is, can CEA stand this up? Can CEA very quickly create the bank accounts, the investment management infrastructure, the financial pieces, start building claim administration procedures, and take on the role of administering this brand new fund? That was one of those questions that there's only one answer to when you're sitting in the governor's office, which is, you know, yes, we'll get it done. We'll do it. And so we had a crazy second half of 2019, which wasn't long after I got here, standing up a brand new insurance operation to do this work. Initially, we were appointed as the interim administrator of the Wildfire Fund, and then later there's a different governance body. It's a California Catastrophe Response Council, 9-member body that oversees our work as the administrator of the fund. We've gotten our first claim from the Dixie Fire. It's going to come from PG&E. It's not going to be huge, but it's testing all the work that we've done to create the right infrastructure to be able to do this work. For the state of California, if you look back, it was a bold move by the legislature to do this, but it's actually working. It has dramatically reduced the cost that the investor-owned utility companies spend every year to buy insurance, because now they can resort to this pre-funded catastrophe fund, the California Wildfire Fund, and those savings have helped to ameliorate what would have otherwise been more significant rate increases for all of us as ratepayers. So those are our 3 key businesses, the mitigation piece. And let me turn now to CEA's focus on diversity, inclusion, and disability access issues. In 2020, we actually formed, in the wake of the George Floyd murder, we decided we needed to institutionalize within our organization our commitment, our core value commitment to diversity and inclusion and mutual respect. Among our core values is the core value of collaboration and respect. And I'll just quickly read it. We engage with all our stakeholders, policyholders, participating insurers, policymakers, consumers, and consumer and industry advocates, the public, and our workforce with a spirit of teamwork, respect, and a strong commitment to diversity, equity, and inclusion. This was an organization that was actually stood up by our employees based on a charge from our CEO, Glenn Pomeroy. You guys decide how we should build it and what we should focus on. And they were very thoughtful and careful about making sure that they thought about this broadly, not just Black Lives Matter and general diversity and equity and inclusion issues, but really wanted to focus on inclusion and belonging. What you see here is a mix of our staff members, many of whom have varying forms of disability that might be invisible to us on a slide, but nonetheless animate the advice that they give to us as a leadership team. They do programming, including presentations from outside parties on issues like disability access. And this has become an integrated and evergreen permanent part of CEA and our operations. And what it's done for us is made us really intentional about when we think about things, how we're doing it, and making sure that we consider access, comfort for everyone who works here. With particular intentional focus on accommodations that they might need or want proactively, not waiting for them to ask for accommodations formally, but thinking about those issues in advance. We are currently, and there's more information on earthquakeauthority.com. It's actually not EQA.com. That's our euphemism for it. But if you use earthquakeauthority.com, there's a page that talks about our commitment to diversity here at CEA, including disability access. We've also stood up a DAC, and I want to credit a relatively recent hire, Zerlina or Z Moore, is our Chief Administrative Officer. She was the one who came in and said, we need to get this DAC formed. We may be, not a state agency, but we have the benefit of being able to hire civil servants. So let's make sure that we honor that commitment. So she got us working on that. We've stood up our DAC. We've done our charter and our bylaws, and they are meeting, and we worked carefully with them to make sure that we initiated the DAC so that they can perform and roll up into the functions that the SDAC is involved in, and that's been a helpful and kind of eye-opening thing. I didn't know this. The other thing I learned was that DAC meetings are automatically subject to the Bagley-Keene Open Meeting Act. I wasn't aware of that, and I was a little bit worried because these are all employees within our office. And if you get too many of them in a room outside of a noticed Bagley-Keene meeting, you might have a Bagley-Keene violation. So we're working to make sure that our staff who want to participate in DAC can do so in a way that's compliant with the statutory requirements, but fulfills that mission. So credit to Z Moore, whom Bobby will tell you we stole from High Speed Rail when we were looking for a new chief administrative officer. She was at High Speed Rail and she joined us. So we're grateful for that High Speed Rail's contribution to the strength of our senior staff. The final thing I'll mention is that as we currently are in an office building downtown, our lease is up at the end of June of next year, and we'll be relocating to a new high rise. And that gave us an opportunity to rethink about how we accommodate our employees in a hybrid workspace where most of our employees are teleworking permanently, And we don't foresee that that will change, even if the governor decides to call people back into the office. We're committed to and have demonstrated over the last years that we have a happier workforce when they have the ability to telework. And we're getting all the work done, and we're staying efficient, and we're fulfilling the mission we have to our policyholders. But this opportunity is an opportunity to build out space that in advance thinks about accessibility, comfort, and accommodation opportunities. So we're building out a much more open, accessible space that'll be over at 400 Capitol Mall, just a few blocks away. And you know, we actually have been working with our architect to think about how to make our spaces comfortable and accessible. Think about people with, for example, sensitivity to light. How do we make sure that we have workspaces that can address that, where they can be comfortable, where they can hotel in on those days that they work and work effectively around whatever they bring to the table. So that's been a really nice part of what we've been doing recently, and an illustration of how the existence of DAC and the thoughtfulness and intentionality that goes into management of our workforce has kind of permeated everything that we do, and will continue to. So that I went on a little longer than I expected, Bobby. Thank you for tolerating that, and happy to answer any questions.
Yes, Tom, that was, again, very informative presentation. And thank you for creating and following Z's advice and having a DAC at your establishment. Z's a good friend of mine. Like you said, it's a great loss to our organization, and I'm glad she's continued to do great work at yours. One question I have, how do you measure the effectiveness of your program, the inclusion and belonging? What matrix do you follow, if there are any?
Well, we you know, obviously we because our staff is made up of about half civil servants and half at will. We call them agency staff. Our statute, because we're privately funded, the legislature in 1996 and 7, when they created us, gave our board, the governor, the treasurer, the insurance commissioner, very broad discretion to build the staff necessary to do the work, right? But because they also gave us the benefit of being able to tap into the amazing workforce that the civil service system provides, and we've been growing our numbers. Initially, we started with a cap. We could only hire 25. That was the maximum, and that was a negotiated compromise in the mid-90s. But a couple of years ago, the legislature lifted that cap, so we've been able to grow our civil service pool of employees, and so part of what we do to monitor and is to do our workforce analysis and create visibility. Not everybody reports their disabilities, or it's not a mandate that you report, but we have data from CalHR that we track. And, obviously we're going to do all of our hiring, whether it's civil service or agency staff, in a way that is legally compliant, but still is intentional. What we do at the suggestion of our DBAC counsel is we're trying to do more outreach recruitment, and when we post recruitments, we do try to find opportunities to advertise those openings in places that will potentially increase the diversity of the applicant pool. So we do that, and then we obviously can't set any quotas because that's not consistent with California law. But Bobby, we really just try to stay intentional and focused on the benefits of having a diverse, inclusive team that does the work for us.
Thank you so much. Do we have any questions for Tom before I bid him goodbye? Speak up if you have any questions. Unmute your speaker and ask anything. If not, I just have one other question, though, Tom. this $21 billion claim paying capacity funding that you established, 50% of that derived from the ratepayer, 50% of the funding or liability comes from the stockholders. Is that sufficient to mitigate the exposure that California faces with the wildfire?
It's an excellent question, Bobby, and I was probably a little bit too summary. The wildfire fund is actually not designed to be a perpetual evergreen fund. What it was designed to do was give the utility companies about 10 to 15 years of running room where they could really enhance the system hardening and mitigation activity that should dramatically reduce the frequency of utility-caused wildfires. And so, one of our responsibilities is to monitor duration. The legislature did not want to create an evergreen burden on ratepayers, and so they did some statistical and hazard modeling with stochastic wildfire models to figure out, how much money do we have to set aside to last statistically at least 10 to 15 years. And the utility companies have done a good job. There's more to do, but they've done a good job of reducing the frequency of really large wildfires since these mandates came in, and since they started doing what are called public safety power shutoffs, where when you get high wind events, Santa Ana's in Southern California or Diablo winds in Northern California Bay Area, they shut down the power and have dramatically reduced the likelihood of their infrastructure triggering a wildfire. So it'll last for a while. I think it'll last at least that 15 years, but as we saw from 2018, when the Camp Fire happened, all it takes is one really, really bad wildfire. And if it was triggered by a utility, we could find ourselves depleted in a year, and then we'll have to see what happens thereafter. But statistically, we think we're going to make that 10 to 15 year horizon. And I know the state and the CPUC and the Office of Energy Infrastructure Safety are going to really work hard to make sure that the utility companies continue to do the strengthening and system hardening that they're obligated to do.
Thank you, Tom. Again, we really appreciate you showing up here and sharing your wealth of knowledge. Keep up the good work with DAC, and happy holidays.
Thank you very much. And thanks to everyone. I really appreciated the opportunity and look forward to listening to more.
And of course, you're welcome to stay on.
I will. Thanks.